Today, the book we're taking a deep dive into is The Creature from Jekyll Island. And before we get into the really heavy material, I want to start with a question that sounds simple, but almost everyone takes for granted. Because when you hear the term Federal Reserve, your first instinct is probably to think of it as a bank run by the U.S. government. Since the word federal makes it sound official, and the news keeps telling us that it regulates the economy and sets interest rates. So over time, most people naturally assume it exists to serve the American public. But right at the beginning of the book, the author, Edward Griffin, throws a punch straight at our perception. Because he says, very bluntly, that the Federal Reserve is neither federal, nor does it hold any real reserves, and in fact, it doesn't even function like a traditional bank in the way most people imagine, which sounds completely counterintuitive at first. But before you rush to reject that idea, the author invites us to look at one simple detail. Have you ever heard of a government bank that was secretly designed by Wall Street elites behind closed doors? Back in the winter of 1910, on Jekyll Island in Georgia, 6 men traveled without their usual staff and checked in under fake names. And among them was Senator Aldrich, who happened to be a business partner of J.P. Morgan, and also the in-law of the Rockefeller family, alongside the president of National City Bank of New York, and an agent representing the Rothschild banking interests, meaning this small group of men, who collectively controlled a quarter of the world's wealth at that time, gathered inside a private island clubhouse, not to create a plan for economic stability, but to craft a set of cartel-style banking rules. Rules about how to centralize smaller banks' reserves into their own hands, how to make taxpayers absorb the cost of bad loans, and how to use the impressive title of central bank to mask a fundamentally private monopoly. What makes it even more ironic is that when the Federal Reserve was officially launched, it was promoted as the solution to bank runs and price instability. Yet in chapter after chapter, the author pulls out historical data showing the opposite. Because the Great Depression of 1929, the double-digit inflation of the 1970s, and the 2008 financial crisis were all fueled, in one way or another, by excessive money creation and policy missteps by the Fed itself. Take the 1970s, for example. Ordinary Americans watched the value of their savings erode year after year, while banks, supported by the Fed's low-interest loans, made enormous profits with almost no risk, which hardly looks like economic stability, but instead feels like a systematic way of draining the middle class for the benefit of those at the top. So when we read this book today, the goal isn't to drown in financial jargon, but to peel away the layers of disguise surrounding the Federal Reserve, to understand whose tool it really is, how it turns debt into wealth through the power to create money out of thin air, and why some people call it the greatest mystery in the history of modern finance. And with that, let's go back to the secret meeting where everything began, because to understand a creature this strange, you first have to understand how it was created. To understand the Federal Reserve, we first have to go back to the key moment before it was even born, back to the winter of 1910, a moment that completely reshaped the American financial landscape. Because while most people assume the Fed was naturally created by the U.S. government to stabilize the economy, Griffin uses a mountain of historical documents to show that the Fed was never some benevolent blessing from above, but rather the product of a secret plan crafted by a small group of financial giants, whose core intention was to monopolize the power of issuing money and take control of the entire economic lifeline of the United States. Let's focus on the famous secret meeting on Jekyll Island, a small island off the coast of Georgia where America's wealthiest elites kept their private retreat. A place so secluded that even reporters struggled to get near it. And in November of 1910, 6 men with extraordinary influence quietly boarded a yacht headed for that island. And what's almost unbelievable is that they traveled under fake names, pretended not to know one another, and even the servants on the yacht had no idea who their real employers were. So who were these 6 men? They were the absolute top tier of the financial world at that time. Leading the group was Republican Senator Nelson Aldrich, a man who wasn't just a politician, but a major partner of the Morgan financial empire, and whose daughter happened to marry into the Rockefeller family. Traveling with him was Frank Vanderlip, the president of the National City Bank of New York, which functioned basically as the Rockefeller family's financial vault, along with Henry Davison, a senior partner of the Morgan firm, and Paul Warburg, the key representative of the Rothschild banking interests in America. To put it plainly, the forces behind these 6 men controlled more than 90% of America's railroads, steel, and financial industries, and held nearly 1/4 of the world's wealth in their hands. Why did they have to meet in secret? Griffin quotes one participant's memoir, which states bluntly that if the public ever found out what they were discussing, it would have caused widespread panic, so absolute secrecy was necessary. And what they were planning had nothing to do with protecting ordinary depositors, but everything to do with merging thousands of small American banks into one giant vault, forcing everyone to play by their rules. Back then, the United States had tens of thousands of small local banks fiercely competing with one another. And whenever the big financial houses wanted to make loans, those small banks would fight to steal business. And if big banks took losses on bad loans, the small banks wouldn't help cover the damage either. So these financial titans had long dreamed of creating a banking cartel, just like oil barons monopolized oil prices, so they could monopolize lending power and interest rates across the entire country. The meeting lasted 9 full days, and in the end, they finalized a core blueprint that later became known as the Aldrich Plan. You don't need to memorize the complicated clauses, just the 2 most important parts. First, all the reserves of small banks across the nation would be concentrated into 12 regional reserve banks, meaning small banks would lose their independence because any lending they wanted to do would require approval from those 12 banks. Second, whenever a financial crisis occurred, the big banks must not be allowed to lose money, so the government would be forced to step in and bail them out, which in essence means using taxpayers' money to cover the risks taken by the financial elite. Griffin comments that this wasn't financial reform at all. It was a set of rules written by wolves to protect sheep, except in the end, it's the sheep who would be paying the wolves' bills. But having a plan wasn't enough. They still needed Congress and the public to swallow it, so these financial giants launched a sophisticated disguise campaign that was incredibly clever. The first step was changing the name. They were creating a privately controlled central bank, but they deliberately avoided using the term central bank and instead called it the Federal Reserve System. Federal made people think it was a government institution. Reserve sounded like it was backed by real gold. And system made it appear professional and decentralized, all of which helped hide the reality of private control behind the scenes. And when some members of Congress questioned whether this institution was public or private, they pointed to the 12 regional banks and claimed that power was spread across the nation rather than centralized. But in reality, the heads of those 12 banks were all handpicked by Wall Street's biggest players. The second tactic was manufacturing a myth. They promoted the idea that the Federal Reserve would stabilize the economy, prevent bank runs, and they even claimed that earlier financial panics would never have happened if the Fed had been around at the time. But Griffin flatly debunks this by pointing to actual history: the Great Depression of 1929, the runaway inflation of the 1970s, the financial crisis of 2008. Every crisis after the Fed's creation was bigger than the ones before it. Take 1929 as an example. Before the crash, the Fed pumped out money at an insane pace, inflating a stock bubble to the extreme, and after the crash hit, it suddenly tightened the money supply, causing countless businesses to collapse and ordinary people to go bankrupt. This wasn't stabilizing the economy, it was triggering the disaster. What's even more ironic is that people who opposed the plan were labeled as backwards and ignorant of modern finance. The media controlled by these financial giants mocked the critics while praising the Federal Reserve proposal as a miracle cure for America's financial future. And eventually, in the dark hours before Christmas of 1913, with many lawmakers already home for the holiday, Congress quietly passed the Federal Reserve Act, and the Federal Reserve was born. From beginning to end, ordinary Americans had no idea that their entire economic lifeline had been handed over to a tiny group of private power brokers. Now at this point, you might wonder why these people went to such great lengths to create a disguised bank. The answer lies in the nature of money itself. Whoever controls the creation and circulation of money controls the wealth of the entire nation. So next, we need to take a quick crash course in what money actually is and the different forms it takes. Because once you understand how money works, you'll understand how the Federal Reserve later used money creation to gradually monopolize power and extract wealth from the public. If you don't understand the logic of money, you'll never understand the Federal Reserve's tricks. In the last section, we talked about how the Federal Reserve was engineered behind closed doors by a handful of powerful financiers, and it naturally raises a question people often overlook. If they went through all that trouble to design the Fed, what were they really after? According to G. Edward Griffin, the answer is straightforward. They wanted control over money itself. But to understand just how powerful that control is, we need a crash course on what money actually is. Because if you don't get the nature of money, all the Federal Reserve's money creation tricks will just look complicated, and you'll never see the hidden leverage behind them. First, we need to separate money into 4 categories, and this is the foundation for everything that follows. Griffin explains them using very simple, everyday scenarios. So you don't need to memorize any academic jargon, just follow the examples. The first type is commodity money, the most tangible form of money, things like gold, silver, or even shells and grain in ancient times. Why could these be used as money? Because they carry intrinsic value. They don't depend on anyone's promise. If you hold a piece of gold, it doesn't matter which country you're in, as long as people recognize its value, you can exchange it for goods. And commodity money has one critical feature. Its supply is limited. You can't print gold. You can't conjure it out of nothing. Whatever is mined is all there is. That's why it resists devaluation. Griffin calls commodity money the most honest money because it cannot be manipulated, and its limited supply protects ordinary people's wealth in a very real way. The second type is receipt money, basically the warehouse receipts issued by goldsmiths in the old days before banks existed. People who owned gold didn't want to keep it at home where it could be stolen, so they stored it with a goldsmith. The goldsmith issued a paper receipt showing how much gold was deposited, and that receipt became tradable. It was easier to carry the paper than the gold, so people began using the receipts to transact. You give me a receipt for 10 grams of gold, and I give you goods worth that amount. Later, you take the receipt back to the goldsmith and redeem your gold. But the key is this: receipt money must be backed by real commodities. If the goldsmith runs out of gold, your receipt becomes worthless. The third type is fiat money, which is what we use today: dollars, yuan, and so on. Its value doesn't come from gold or any physical commodity. It comes from government decree and collective belief. The government prints a piece of paper that says $100 and legally requires everyone to accept it in transactions. As long as people believe others will exchange real goods for it, it functions as money. Fiat currency is convenient and allows governments to manage the economy, but there's a huge downside. If the government prints too much of it, or if public confidence collapses, fiat money can lose value rapidly. History is full of examples where a bag of banknotes could barely buy a loaf of bread. The fourth type is fractional reserve money, the core of modern banking's ability to create money out of thin air. Here's how it works. You deposit $100 in a bank. Under fractional reserve banking, the bank only needs to keep, say, $10 as reserves and can lend out the remaining 90. The borrower then deposits that 90 into another bank, which keeps 9 and lends 81, and the cycle continues. That original $100 can expand into $1,000 of credit money. Griffin calls this process the creation of money from nothing. The extra $900 aren't earned, saved, or produced by anyone. They are manufactured by the banking system. And this leads to a crucial point. Different types of money offer different levels of control. Commodity money like gold is the hardest to manipulate because its supply is fixed. Receipt money is safer as long as it's backed by real goods. But fiat money and fractional reserve money are extremely easy to manipulate. And whoever controls the printing press and the reserve ratio rules essentially controls the entire economy. Griffin emphasizes repeatedly that gold matters not because it's precious, but because it restrains power. Under the gold standard, governments and banks cannot create unlimited money. They must hold real gold to back new currency. Before 1971, one U.S. dollar represented 0.888 grams of gold, and the government couldn't print more dollars unless it had the gold to match. But when Nixon ended gold convertibility in 1971, the dollar became a pure fiat currency, and the Federal Reserve could expand the money supply without laying the groundwork for inflation and future financial crises. History offers clear warnings. The continental currency in early America had no gold backing. The government printed endlessly, and it soon collapsed. In the later Roman Empire, emperors kept reducing the silver content of the coins until they were basically copper discs. The monetary system fell apart, and the empire deteriorated soon afterward. These examples show that once money is no longer tied to real commodities and can be created freely, ordinary people ultimately pay the price. Now that we've clarified these 4 types of money, the Federal Reserve's operations become much easier to understand. In the next section, we'll talk about the Mandrake mechanism, the Fed's way of pushing fiat money and fractional reserve banking to the extreme. How it creates money by purchasing government bonds, how it turns $1 into 10, and how it transforms debt into wealth while silently draining the savings of the public. And all of this rests on the very foundation we just laid: what money is, and how different types of money can be controlled. Now that we understand the 4 types of money, we can finally break down the Federal Reserve's most powerful money-making engine, the Mandrake mechanism. Griffin calls it a modern form of alchemy because it allows the Fed to create money out of thin air and even turn government debt into banking profits. And although the whole operation looks complicated from the outside, once we walk through it using something as simple as a mortgage example, the hidden trick becomes very obvious. The core idea behind the Mandrake mechanism is this: debt is transformed into dollars. So let's start with step 1. When the government runs short of money, say, it wants to build highways or expand social programs, but its cash on hand isn't enough. It issues U.S. Treasury bonds. A Treasury bond is basically a formal IOU from the government that says, here's how much we owe you, and we'll pay you back with interest in a few years, which is just another way of saying the government borrows money from the public. Then we get to step 2, where everything begins to look surreal. The Federal Reserve steps in and buys those Treasury bonds, but the Fed doesn't pay for them with existing money. Instead, it writes a check backed by absolutely nothing. If the government issues $10 billion in bonds, the Fed simply writes a $10 billion check, hands it to the Treasury, and the Treasury deposits it into commercial banks. At that moment, the $10 billion becomes newly created dollars, and the government can now spend it on roads, salaries, or welfare programs. The key trick here is that the Fed's check isn't backed by gold or savings, or even the Fed's own assets. It is literally created out of thin air, just numbers written on a piece of paper. Yet it gives the government real purchasing power in the economy. Next comes step 3, where commercial banks amplify the creation of money through fractional reserve banking. Once the Treasury deposits that $10 billion into the banking system, banks are required to keep only a fraction, say 10%, as reserves, while the remaining $9 billion can be lent out. A borrower then deposits that $9 billion into another bank, which keeps $900 million in reserves and lends out the rest, and the cycle repeats. Through this chain reaction, the Fed's original $10 billion can expand into $100 billion of credit. Griffin runs the math. With a 10% reserve ratio, every $1 of base money, the money created by the Fed, can generate $10 of broad money created by the banking system, meaning the entire banking network is manufacturing money, and all of it originates from the Fed's original empty check. At this point, you might wonder whether the Fed and commercial banks face any real risk. Technically, yes, but they never end up paying for it. The ones who pay are ordinary people. Griffin highlights the 2008 financial crisis as a perfect example. Banks had been issuing mortgages to people who clearly couldn't repay them, the infamous subprime loans, and when those mortgages started to default, the mortgage-backed securities in the bank's hands turned into toxic assets. Under normal circumstances, the banks should have taken the loss, but instead the Federal Reserve stepped in, fired up the Mandrake mechanism again, created huge amounts of new money, bought up those toxic assets, and even offered banks zero-interest loans. The result? No major banks collapsed, executives continued collecting massive bonuses, and all that newly created money poured into the economy, pushing prices up and making ordinary people's savings worth less and less. This is what Griffin calls the inflation tax. You don't pay it with a form, but your wealth is quietly taken through the erosion of purchasing power. What's even more disturbing is that under the Mandrake mechanism, the dollar itself is nothing more than government debt. Every dollar that comes into existence corresponds to a debt the government owes the Federal Reserve. And to repay that debt, the government must either raise taxes or issue even more bonds. So the cycle never ends. The more the government needs money, the more bonds it issues. The more bonds it issues, the more money the Fed creates. The more money the Fed creates, the faster the dollar loses value. And the heavier the burden becomes on ordinary citizens, either through direct taxation or through inflation. Griffin's conclusion is blunt. The Mandrake mechanism isn't monetary management, it's wealth extraction. It shifts savings away from the public and funnels it toward bankers and the government through the process of money creation. And once you understand the Mandrake mechanism, American financial history becomes far easier to interpret. You begin to see why the first 3 U.S. central banks were eventually shut down, and why the Federal Reserve has survived for more than a century. In the next section, we'll talk about how those earlier central banks were overthrown for private monopolistic abuses, and how the Federal Reserve redesigned the system to make its own monopoly far more subtle, far more durable, and much harder for the public to recognize or challenge. A design perfectly aligned with the extraction logic behind the Mandrake mechanism. Griffin devotes a huge portion of his book to telling the stories of America's first 3 central banks. And he isn't doing it to fill space. The Federal Reserve is not America's first attempt at a central bank. And the reason too aggressive and too harmful to the public. The only reason the Feds are making it far harder for the public to see what it really is. Let's start with the first Bank of the United States, created in 1791. America had just won independence. The government was drowning in war debt, and the entire fiscal system was in chaos. Treasury Secretary Alexander Hamilton pushed for a central bank to manage federal debt and issue a national currency. But the ownership structure was impossible to ignore. The U.S. government held only 20%, while the remaining 80% belonged to private investors, including a large amount of foreign capital from British and Dutch bankers. And once the bank opened, It quickly began manipulating the money supply, deliberately tightening credit so farmers and small businesses couldn't repay their loans, forcing them to sell their land and assets at bargain basement prices. Meanwhile, the bank's private shareholders swooped in, bought everything cheap, and made a fortune. The public paid the price. Secretary of State Thomas Jefferson warned that giving control of America's money to foreign financiers was essentially undermining the foundation of the nation itself. In 1811, when the bank's 20-year charter came up for renewal, Congress voted, by a razor-thin margin, not to renew it, and the first central bank died. The lesson was obvious. When the private monopoly next came the Second Bank of the United States in 1816, America had just finished another war with Britain. The finances were a mess again, and Congress resurrected the central bank idea. The second bank looked almost identical to the first. The government owned 20%, private shareholders owned 80%, and the real power stayed in private hands. But this bank went even further, manipulating credit and openly interfering in politics. During the presidential election of 1828, the bank threw its support behind Andrew Jackson's opponent. When Jackson won, he immediately pulled all federal deposits out of the bank and moved them into state banks, effectively cutting off its financial lifeline. Jackson denounced the bank as a monster, an institution that made a handful of men rich while impoverishing the majority, and insisted it had no right to exist. In 1836, when its charter expired, Congress refused to renew it. The second central bank collapsed as well. Its lesson was even sharper. A private monopoly that openly meddles in politics will not survive. Then came the national banking system of 1863, America's third attempt. Private banks were allowed to issue their own currency, but only if that currency was backed by U.S. government bonds. The more bonds a bank bought, the more money it could issue. This meant the money supply rose and fell with federal debt, creating constant cycles of shortage and surplus. And large banks, which could buy more bonds, gained more influence over the entire system, while small banks were forced to accept whatever conditions the big banks created. Ordinary people suffered the most. By the 1907 financial panic, the flaws were undeniable, and the country demanded something better. That demand opened the door for the Federal Reserve. The genius of the Federal Reserve is not that it fixed the old problems, it simply hid them. First, it avoided the term central bank altogether and called itself the Federal Reserve System, a name that sounds like a government agency instead of a private banking cartel. Second, it created 12 regional Federal Reserve banks, giving the illusion of decentralized power, preventing the public from thinking everything was controlled by New York. But in reality, the leadership of those banks has always been chosen by Wall Street institutions and approved by the government. The real power, take the New York Fed. It runs the Fed's daily operations, controls the buying and selling of government bonds, and its president traditionally serves as the vice chair of the FOMC, often wielding more practical influence than the Fed chair himself. And the Fed hides private ownership even deeper. Only member banks can own stock in the Federal Reserve banks. That stock can't be sold, and the dividend is fixed and tiny, making it look like a non-profit obligation rather than ownership. But membership gives banks privileged access to cheap loans, government operations, and long-term advantages far more valuable than dividends. Griffin jokes that the Fed is like a man wearing a government coat, but underneath, it's still a private banker's body. The first three central banks died because their exploitation was too obvious. The Fed survived because it made the same extraction system invisible. Different mask, same core, concentrated monetary power serving the few. And now it's time to ask the real question. After all these years, what has the Federal Reserve actually done for America? Has it truly stabilized the economy, protected the public, lived up to its promises? That's what we're going to break down next, the Fed's real report card, and why Griffin argues it should be ended altogether. When the Federal Reserve was created in 1913, it made three grand promises to the public: to stabilize the economy, to prevent financial crisis, and to protect the value of the currency. But Griffin digs through nearly a century of economic data, and the bill he presents is shocking, because the Fed not only failed to deliver on its promises, it effectively became the engine of economic turbulence, the driving force behind the collapse of the dollar's value, and one of the most efficient wealth extraction machines ever built. Today, we're going to tear open its report card and see exactly why. Griffin believes this institution shouldn't just be reformed, it should be ended. Let's start with the first promise: stabilizing the economy. People often credit the Fed with smoothing out economic cycles, but almost every major disaster in American economic history has the Fed's fingerprints all over it. Before the 1929 Great Depression, the Fed slashed interest rates and flooded the system with credit, sending money pouring into stocks and real estate, inflating one of the biggest bubbles in U.S. history. Between 1928 and 1929, the stock market more than doubled. Ordinary people were borrowing money just to speculate. And right when the bubble was at its peak, the Fed suddenly tightened the money supply and stopped lending to banks. Banks ran out of cash, raced to call in loans. People were forced to liquidate their stocks and property. The market collapsed, businesses failed, and the Great Depression began. Griffin cites research showing that if the Fed hadn't slammed on the brakes at that exact moment, the Depression might have been half its size. Then we get 2008. The Fed kept interest rates extremely low for years, encouraging banks to hand out subprime mortgages to people who simply couldn't repay them. Those risky loans were bundled into derivatives and sold all over the world. When the defaults finally hit, the entire financial system imploded, and once again, taxpayers had to clean up the mess. And the Fed, the supposed regulator, didn't warn anyone. It was part of the problem. Now the second promise: protecting the value of the dollar. This might be the most embarrassing score on the Fed's report card. In 1913, one U.S. dollar could be exchanged for about 0.888 grams of gold. $100 could buy a cow or 2 acres of land. By 2023, the dollar's purchasing power had fallen to about 5% of what it used to be. $100 can't even buy half a bag of flour. Why did this happen? Because the Fed has been printing money without restraint. After the dollar was cut loose from gold in 1971, there was no brake, no anchor. The Fed could print whatever it wanted. After the 2008 crisis, it created trillions through quantitative easing. During the 2020 pandemic, it printed nearly 3 trillion more. All that new money flooded into the economy, driving prices higher, while wages for ordinary people barely budged. This is what Griffin calls the invisible tax. Your money loses value, while the wealthy, whose wealth sits in assets like stocks and real estate, watch their net worth surge. From 2020 to 2022, U.S. home prices jumped 40%. The stock market gained 50%, but the average worker's income rose only 10%. Guess who pays the price? Ordinary people. Now the third promise: fairness. The Fed claims to serve the public, but in reality, it functions as a privilege machine for the few. And nothing makes this clearer than the fact that big banks simply don't die. In 2008, Citigroup, Bank of America, and other giants were on the brink. The Fed stepped in immediately, providing low-interest loans, buying toxic assets, even injecting cash directly into them. At the exact same time, nearly 500 small banks collapsed, and the Fed didn't lift a finger because small banks aren't systemically important. The logic is simple. Big banks are shareholders of the Fed. They sit close to the money spigot, and small banks are expendable. Even more unfair, the Fed's perpetual money printing widens the wealth gap. The wealthy own assets that rise when money loses value, while poorer households hold cash and savings that shrink in real worth. From 1913 to 2023, The top 1%'s wealth share grew from 18% to 40%, while the bottom 50% fell from 20% to under 2%. The Fed has become an accelerator for inequality. But Griffin points out one more fatal issue. The Fed is a war machine. Every major U.S. war relies on the Fed's ability to print money. During World War I, the Fed created the funds that allowed the U.S. to jump into the conflict. In World War II, it pumped out mountains of dollars to support global military operations. During the Cold War, it fueled America's proxy battles and geopolitical interventions through the power of the dollar. Why would the Fed support war? Because war lets governments issue massive amounts of debt. The Fed buys that debt with newly created money, and bankers earn fortunes financing the conflict. Griffin cites a famous Rothschild line, "Permit me to control a nation's money, and I care not who makes its laws." The Fed's control over money makes it a hidden driver of war, while ordinary soldiers and citizens pay the real cost in blood and in wealth. So now you can see why Griffin argues that the Federal Reserve shouldn't exist. It broke its promises from the very beginning and instead became a source of instability, a force of inflation, and a mechanism of upward wealth transfer. But if the Fed were actually ended, what would come next? What would America's monetary system look like? And how can ordinary people protect themselves in the meantime? That's what we'll talk about in the next part, the future of the Federal Reserve and what we can do about it. Griffin doesn't end his book with a radical claim that the Federal Reserve will collapse tomorrow. Instead, he projects two possible futures based on his operating logic and historical patterns. One is a pessimistic scenario where crises intensify, and the other is an optimistic scenario where public awareness forces reform. These futures aren't pulled out of thin air. They naturally extend from the Fed's cycle of money creation, debt accumulation, and wealth extraction. Let's break them down. The first, and what Griffin considers more likely, is the pessimistic scenario, a vicious cycle of debt crises and runaway inflation. When he wrote the book in 2017, U.S. government debt had already surpassed $33 trillion. Today, it's $36 trillion, which means over $100,000 in debt per American. The way to manage this debt is essentially still the Fed's Mandrake mechanism. The government issues new debt. The Fed prints money to buy that debt, and old debt is rolled over with new debt, delaying the problem. But this cycle has a fatal flaw. If the market loses faith in the dollar, or if other countries stop holding U.S. debt, the whole system could collapse. Imagine this. To pay off old debt, the U.S. issues more bonds. The Fed prints more dollars to buy them, and the more dollars printed, the faster the dollar devalues. Other countries, worried about losing value on their dollar holdings, start selling U.S. bonds and trading in other currencies. For instance, many countries now use the yuan or the euro for oil transactions. When a sell-off hits, the U.S. has to raise bond yields to attract buyers. Higher yields mean higher borrowing costs for businesses, more pressure on mortgages and car loans for Americans, and the economy could slip into stagflation, simultaneous inflation and recession. Even worse, if the dollar loses its status as the world's reserve currency, the U.S. can no longer buy goods from around the globe simply by printing money. Prices would skyrocket, and the standard of living for ordinary people would plummet. Griffin gives an example. If the dollar lost 50% of its value, the $100 you spend on daily necessities today would cost $200 tomorrow. Wages won't keep up, and many families would struggle just to put food on the table. Another hidden risk in this pessimistic scenario is a systemic collapse of the financial system. U.S. banks now rely on low-interest loans from the Fed and quantitative easing, accumulating high-risk assets like commercial real estate loans and highly leveraged derivatives. If the Fed is forced to raise rates to fight inflation, like it did in 2022, those assets could quickly lose value. triggering another wave of bad debts. The collapse of Silicon Valley Bank in 2023 was actually a warning of this risk. Bonds held by banks lost value as rates rose, depositors panicked, and the bank went bankrupt in a matter of days. If the Fed doesn't change its model, more banks could fail, potentially triggering a financial crisis even worse than 2008, putting ordinary people's deposits at risk. The second scenario, which Griffin holds hope for, is the awakening scenario. This isn't about violently overthrowing the Fed. It's about public awareness forcing a reform of the monetary system. Griffin repeatedly emphasizes that the Fed's greatest shield is not the law, not the government, but the public's ignorance. As long as most people believe the Fed is just a government bank, and that inflation is the fault of greedy corporations or banks trying to help, the system will persist. But if more people understand the nature of money and see through the Fed's tricks, things change. When people realize inflation is caused by excessive money printing, they will oppose unchecked quantitative easing. When they understand that big banks use taxpayers' money to cover private bad debts, policies will be pushed to limit executive pay and allow failing banks to collapse. Awareness that the dollar has been depreciating since it broke from gold will drive people to protect wealth with gold, silver, or other commodity money, indirectly pressuring the government to reconsider currency anchors. Griffin points out that some U.S. states have already started legalizing gold and silver circulation, like Utah and Arizona, and lawmakers have proposed auditing the Fed. These are all signs of public awakening. The essence of this hopeful scenario isn't to destroy the Fed, but to restructure monetary power, returning currency issuance to something anchored in real assets, freeing the banking system from private monopolies, and shielding ordinary people's wealth from hidden taxation. This could mean restoring a gold or commodity standard, limiting the Fed's ability to print money, decentralizing banking to give small banks and ordinary depositors more influence, and legally requiring the Fed to disclose its accounts for public oversight. Griffin says monetary power should belong to all people, not a handful of bankers. Once the public realizes this, change begins, whether the outcome is the pessimistic or hopeful scenario. One thing is certain: the Fed's current model is unsustainable. Debt and inflation are ticking time bombs, and the difference is whether we passively suffer when the crisis explodes, or consciously wake up and push for reform. For ordinary people, understanding this logic isn't about predicting the future. It's about protecting yourself, knowing how to deal with inflation, choose safe financial tools, and avoid being harvested by financial elites. This is the final topic we'll discuss. After reading Griffin's book carefully, how we can act to avoid being exploited by the Fed. We spend so much time reading Griffin's book on the Fed, not to dive into financial conspiracy theories, and certainly not to complain about wealth being taken from us. The main goal is to find ways to protect ourselves. Griffin says at the end of the book that the best way for ordinary people to counter the Fed isn't to overthrow it, but to build their own wealth firewall. This firewall doesn't have to be complicated. Just remember 3 practical actions. First, update your mindset. Don't think that simply putting money in the bank is safe. Think in terms of protecting against inflation. Many people believe that cash in the bank is the safest option, but after reading the book, it's clear. In the Fed's logic of unlimited money printing, cash is actually the fastest depreciating asset. Money that could buy 100 pounds of rice 10 years ago might only buy 70 pounds today. So don't obsess over how much you save. Focus on how to preserve purchasing power. For example, if you have $100,000, don't keep it all in cash. Regularly allocate a small portion, say 20%, into assets that hedge against inflation, like gold, even something like a small gold ETF, or prime real estate and real estate funds. These assets usually rise in value with prices and help offset the hidden tax of inflation. Second, diversify. Don't put all your eggs in one basket. Crises triggered by the Fed are never just one thing. Sometimes it's the stock market crashing, sometimes the property market plunging, or currency devaluation. If you invest everything in one place, one misstep, and you could lose it all. You don't need a complicated portfolio. A simple three-way split is enough. Keep a third in cash for daily expenses and emergencies, a third in stable assets like government bonds or high-grade bonds, and a third in growth assets like quality stock index funds. This way, whether it's inflation or deflation, part of your wealth will always hold up against risk. Third, watch the monetary signals and don't be swayed by expert jargon. The Fed's harvesting of ordinary people is often hidden in technical terms. When they talk about quantitative easing as stimulating the economy, they're really just printing money. When they raise rates to control inflation, they're making mortgages and loans harder for regular people. You don't need to understand complex financial models, but remember two simple signals. If the Fed announces balance sheet expansion, buying bonds and printing money, be wary of inflation and hold less cash. If they announce rate hikes, be careful with debt and don't blindly take loans to buy property or stocks. Check the Fed's public reports regularly. You don't need to understand everything. Just focus on key data. Don't blindly trust anyone claiming a certain asset is risk-free. Make your own judgments so you don't get harvested. Finally, Griffin didn't write this book to make us anxious. He wrote it to make us aware. No matter how powerful the Fed is, it can't control our rational wealth planning. Don't follow the herd. Don't chase high returns blindly, and don't be fooled by false security. Embedding inflation protection and risk management into your financial mindset is the best way to safeguard your wealth. After all, in finance, there's no savior. The only thing that can help you avoid getting harvested is your own logic and rational action. And finally, congratulations. You've just finished another book.